Alright, gonna do a little video here to help you with your assignment number one, and I see some of you've already completed it and turned it in, and you can check yours and see, if you've made any mistakes, and if you want to go back and change those. I've allowed you to do a second attempt where you can just redo the ones that maybe you missed. So really what a mortgage is a loan that you're going to take out on a piece of property, specifically a home. So the goal of the assignment is to look at the difference between purchasing a $260,000 home and a $120,000 home. And I gave you a couple examples here of what you get at those price levels. So you can click and it'll take you, and that kind of a new house, $260,000. This is in new homes, so it's relatively close to where we live, and gives you kind of an accurate idea. The tool that you're using is this mortgage calculator. So once you click on this is going to take you to the tool that you need. But here's some important information. You're going to need the value of the home, and you're going to have to do this twice, right? Because you got two houses. And the other thing is you've got your interest rate here and your term. So you've got a 30-year loan on the big house and a 15-year loan on the smaller house, less expensive home. So what this means is just the length of how long you have to pay back that loan. And the shorter that shorter loan term that you have, right, the more expensive your payment is going to be, obviously, but also the less interest you'll pay over time. So we're going to kind of look at the differences in payments with these two setups. Payment will be relatively the same, or close to the same, but you will be done with House B much quicker, twice as fast. So if I click on that mortgage tool, it takes me, I'm going to pull this over a little bit, there we go, to the Bankrate mortgage calculator. So if you want to put in your home, and we had $260,000, and you may have to have it, you will have to have a down payment when you buy a home. 20% anymore is pretty uncommon. That used to be kind of the way it was, but anymore 20% isn't really something that happens a whole lot. What we got to look at here is okay. What I say? Okay, 4.9%. So you come down here and you put in your interest rate of 4.9. Your term is at 30 years. Your down payment, I didn't talk about a down payment, so let's just go 0 right now. And you have actually, so it gets a little bit more realistic. We'll put 5% down. And that is going to be a typical down payment for a home. Probably a little bit more on a house this expensive, but 5% is, for today, 5 to 10% is a pretty good down payment on a home. Okay, so then you get some information. First of all, you get the payment amount. Okay, so that's your estimated monthly payment, and some things that go into that. This is the principal, which is the amount that you're paying back, and then the interest. This is what you have to pay in order to borrow it. So those two are $1,300. You've got homeowners insurance, and you have property tax. Now these are liabilities. These are things you got to pay every month, and these are estimates based on the value of the property. But you got to insure your home in case it burns down, and the bank's going to make sure that you have insurance. And you have to have you got to pay your property taxes every month. And usually when you purchase a home, you have what's called an escrow account, and they take this money out so that you don't get to April 15th and October 15th and have no money to pay your property tax. So they do that ahead of time and take it out and make it part of your payment. So $1,300 is going to pay back the loan. That's principal and interest, and then you've got some of these other things that go into that make up your $675 payment. So if you look at your assignment, and I'm going to hit preview here quick. Okay, what is the monthly payment? So then, you can put that in here. Now it says use the amortization schedule. This is an important thing to understand and kind of really the big goal. So you click on this amortization schedule, and this is going to outline every single payment that you make. So here you'd be your first house payment would be June. Your payment is $1,310. Remember, right? That's your principal plus interest. Okay, principal plus interest. The other stuff that's of your $1,675. Some of that's property tax and other things. But I want you to look at this. So out of your first payment, only $300 of that $1,300 is going to pay off the actual loan that $246,000 that you borrowed. 1,000 of it is interest, right? See, banks get their interest first. So in the first year, right, all the way up to December of 2020, you will pay $7,000 in interest, only $2,000 back towards your balance. So you can see this interest is going to add up really quick. And every payment that you make going forward, your principal will grow and your interest will shrink. So that's kind of important to know and understand. So it says, how much interest will you pay on house A over the life of the loan? Well, you can just go all the way down to the bottom and move me out of the way here. So at the end, you can come down, here's my interest, and I come down here, just on this house, just in interest, I'm paying $225,000, almost as much as the house cost, just in interest. So that's what the bank is getting paid for loaning me that $245,000 that I borrowed. I'm paying $225,000 just to borrow. I got to pay the other back, right? I got to pay the $246,000 back, but I got to pay another $250,000 on top of it. So that $260,000 home is going to end up costing me $472,000. And that's something that people always realize when they get into these 30-year loans, is how much in interest it is going to cost you. So we go back to our questions. How much interest will you pay? How much interest will you pay over the life of the loan on house B? So you're going to do the same thing, right? When you go into house B, okay, you're just going to have to change a couple things. Obviously the purchase price, I think that was 120 maybe. I think that's what it was. But here's what we need to do. We need to change the term from 30 to 15. And because you're doing a shorter loan, you also, right, have a lower interest rate. And I think it was 3.8, 3.9, I can't remember. But and that's going to lower your payment quite a bit. The shorter term that you get, you usually are going to get a little bit better of a rate. But you can see how your interest rate really affects your payment. Going from 3.8 if you have really good solid credit to 4.2, right, increases your payment there, 4.9 and so on. So having that good interest rate makes a difference. So here we go. We got our new payment there. I have no down payment on this one. I hit the amortization schedule. You can see there's my payment plus interest, homeowner's insurance, property tax. Obviously a less expensive home, less in taxes, less in insurance. But I've got my payment. And here's the big difference that you should be able to see is the amount of interest on a 15-year loan versus a 30-year. Remember, right? Remember when we looked at the first payment of the 30-year loan, the interest was significantly higher than the principal. Well, here, okay, the principal is higher, okay, than the interest, which is a big, big deal, right? Remember, in that first year, we would have paid over $7,000. Now we're only at $2,000, and your interest is going to fall just like in the 30-year, but in the 15-year, it's just going to get paid up that much quicker, and your principal balance is going to come down that much quicker, thus reducing your interest even more. So if you go to the end of this loan, and oops, So at the end of 2035, 15 years in the future, instead of that $225,000 in interest, I've only paid $37,000. Right? So that $120,000 home ended up costing me $157,000. Now, here's kind of the thing that you can think about, the difference between starting early and with the big house, is now I'm 15 years in, and remember, I still have 15 years of a mortgage payment to go on the big house. And part of your question, right, was to look at, remember, you will pay your house off in house B in 15 years. How much will you have paid in interest on house A after 15, and how much will you still have left? You still have 15 years left of house payments. House B is done. Now you have a choice. You can live in your house and not have a house payment, which would be awesome. Take that money and invest it in something else. Or now you have an asset that is appreciated. It's $120,000 when you bought it. It's probably in the neighborhood of 15 years, $160,000, $170,000 in value. You could sell this and now use that $170,000 to go and buy that nicer home that you wanted and take out another lower interest 15-year loan. And what that's going to do is allow you to save a ton of money in interest. So there's a huge advantage to starting small, getting something paid off early versus starting kind of with the dream home right away, even if you can afford the payments. So hope that helped a little bit. If you have questions on that amortization schedule, how to use it, let me know.